This is your technical update from the LMAX Exchange Research and Analytics Desk for Wednesday, March 2nd, 2016. Euro dollar. So the euro remains under pressure and the market is now closing in on a retest of that early 2016 low from early January at 107.11. At this point, look for any rallies to now be well capped by previous support now turn resistance in the 110 area, with only a break back above recent highs that we saw at 110.69 to take the immediate pressure off the downside. Sterling dollar. So cable is seeing a bit of a bounce out from recent 7-year lows that were seen earlier this week at 138.36, but the market is still classified as trading within an intense downtrend, and as such any rally should continue to be very well capped in favor of the next downside extension towards that key measured move objective at 135 further down. 135 is a major level because it also coincides with the multi-year base from 2009. At this point, only back above 40.80 on a close basis would take the immediate pressure off the downside. Dollar yen. So although we've seen a bit of a bounce in dollar yen over the past couple of sessions, ultimately the market remains confined to a consolidation off the recent lows, and a break back above 116 would be required to take the immediate pressure off the downside. Until then, there is risk for this rally to stall out yet again in favor of another downside move towards that recent multi-month low at 110.98. Euro Swiss. So Euro Swiss has seen some setbacks in recent trade, though ultimately, while the market holds above 107.15, the market retains its constructive recovery outlook in favor of what should be the next higher low and fresh upside extension beyond the recent multi-month high at 112 and towards the 115 area further up. Only back below 107.15 would really compromise this outlook. Aussie dollar. So Aussie has been very well bid over the past several days, with the market trading up towards a 78.6 Fib retracement off of the key 73.85 move down towards the recent low that we saw early 2016, that multi-year low at 68.27. Any rally should be should prove hard to see any sustained gains beyond that 72.65 area despite this latest correction, with the market adhering to a broader downtrend. If we do see a break above 72.65, this could expose 73.85 further up, and a break back above that level would be required to negate the current downtrend in Aussie dollar. Look for the market to once again cap out towards 72.65 or ahead of 73 in favor of the next downside extension and renewed weakness. Dollar CAD. So dollar CAD has seen setbacks extend off that near 13-year high from early January at 146.90, with the market taking out some key rising trendline support off the May 2015 low and trading down into the 133s thus far. At this point, there is risk for this correction to continue now towards the 78.6 Fib retracement off of the October 2015 to January 2016 high move, which comes in at 132.30. Ultimately, only a close back below 132 would take the immediate pressure off the top side and suggest that this market could see even more meaningful declines. Again, overall, the structure is constructive and favors the higher low in the sessions ahead in favor of the next bullish continuation. Kiwi dollar. So Kiwi rallies continue to be very well capped up towards 67.75, with the market stalling ahead of critical resistance at 69 and looking like it wants to put in a lower top. Look for a break back below 65.46 to strengthen this outlook and expose more critical support at 63.47 further down. SPX 500. So although we've seen some impressive gains in the SPX 500 over the past several sessions, while the market holds below 2,000 and some previous support term resistance around 2,000, we have 1993 as that low that we saw going back to the 14th of December, the market retains its bearish outlook and is expected to put in a lower top somewhere around that level, around 2,000, in favor of the next downside extension below 1808, those recent multi-month lows, and towards 1,700 further down. Really, only a close back above 2,000 would delay this bearish outlook. Gold. So although we've seen a bit of setbacks in recent trade in gold, the market retains its constructive outlook while it holds above the 1192 previous breakout area and ultimately is expected to consolidate above that 1192 level in favor of the next major upside extension to retest the 2015 high from January at 1307 further up. Only a close below 1192 at this point would delay that constructive outlook and newly adopted bullish outlook for gold.